SCHD stock split is a great opportunity, but imagine pairing it with three other dynamic stock splits. So, if you've been following the market, you probably heard about SCHD's recent 3-for-1 stock split. For those who love dividend-focused ETFs, this is pretty big news. By lowering the price per share, SCHD just became even more accessible to retail investors, and that's a win for anyone looking to add steady income to their portfolio. SCHD is known for its reliable dividends and solid performance, which is why it's been a favorite among dividend investors, myself included. But here's the thing. While SCHD is an amazing option for consistent dividends, there are some other stock splits that could make your portfolio even stronger. Think of SCHD as your foundation, providing that dependable income. Now imagine building on that foundation with a few high-growth stock splits that bring extra diversity and potential. In this video, I'm going to show you 3 exciting stock splits that can add a new dimension to your investments. We'll explore how these can work alongside SCHD, giving you both stability and growth. Chapter 1. Overview of the SCHD stock split. Accessibility and income potential. Let's start with a quick look at what makes SCHD's stock split such an interesting move. The Schwab US Dividend Equity ETF, or SCHD, has always been popular for its high focus on high-quality dividend stocks. By splitting its shares 3-for-1, Schwab is making this fund even more affordable for individual investors who may have previously found the price a bit out of reach. Here's how it works. With a 3-for-1 split, each share you owned now becomes 3. The price per share is reduced, but the overall value of your investment remains the same. This makes it easier for more people to buy in, especially if they're investing on platforms that don't offer fractional shares. Now, let's talk about why SCHD stands out. This ETF is packed with companies that have a long history of paying dividends, which makes it a solid pick for anyone looking to create a steady income stream. It combines stability with reliable returns, thanks to its diverse holdings across sectors like consumer goods, healthcare, and finance. So, while the stock split doesn't change SCHD's fundamentals, it does make this strong ETF even more accessible. But if you pair it with some promising stock splits, it can boost your portfolio even more. Chapter 2. Stock Split Number 1. Lam Research, LRCX, adding tech growth to your portfolio. Take Lam Research for example, ticker symbol LRCX. Recently, Lam completed a 10-for-1 stock split, making it a lot more accessible to investors. Lam Research is a major player in the semiconductor manufacturing space, providing essential equipment used by companies like Intel and TSMC to provide chips. This sector is critical, as demand for semiconductors has surged due to the growth of industries like AI, 5G, and electric vehicles. Lam Research has consistently shown strong financial performance. In 2023, the company reported $18.7 billion in revenue, up nearly 18% from the previous year, and it's on track to grow even further. With a PE ratio of around 22, it's trading at a discount compared to many of its peers, which could indicate room for appreciation as demand continues to increase. Adding LRCX to a portfolio with SCHD can bring both stability and growth. SCHD provides dividend income, while Lam Research gives exposure to a tech sector that has long-term tailwinds. Lam's operating margin is over 30%, highlighting its efficiency and profitability, and its recent stock split makes it even more accessible to investors looking to benefit from tech growth at a more affordable entry point. Chapter 3. Stock Split Number 2. Super Microcomputer, or SMCI, tapping into data center and AI growth. Now, let's look at Super Microcomputer, ticker symbol SMCI, which also completed a 10-for-1 stock split, making SMCI shares more accessible, and it's well-timed, as the company is positioned at the heart of 2 rapidly expanding sectors, data centers and AI. Supermicro builds servers and specialized systems that power the world's largest data centers, essential infrastructure as demand for cloud services and AI capabilities grows. SMCI reported $7.1 billion in revenue for fiscal 2023, representing a 33% increase from the previous year. The company is capitalizing on strong demand from tech giants investing heavily in data infrastructure. It currently trades at a PE ratio of approximately 12, which is significantly lower than industry peers, suggesting it may be undervalued given its growth potential. For those already holding SCHD, adding SMCI provides a balanced approach. SCHD offers reliable dividend income, while SMCI delivers growth exposure through cutting-edge tech. Analysts expect SMCI's earnings to grow over 25% next year, driven by high demand by scalable and energy-efficient servers. With a gross margin of around 18%, Supermicro is efficiently managing costs while expanding its market share, making it a compelling choice for those looking to diversify with a tech stock positioned for the future. Chapter 4. Stock Split Number 3. Potential Split Candidates. Mercado Libre, or MELI, and Booking Holdings, BKNG, for industry dominance. Let's now consider two high-priced stocks that haven't announced splits yet, but have strong growth potential. Mercado Libre, ticker symbol MELI, and Booking Holdings, ticker symbol BKNG. Both are leaders in their respective industries, with share prices that put them out of reach for many investors, making them prime candidates for potential stock splits. Mercado Libre is the largest e-commerce platform in Latin America, often compared to Amazon in the US. The company reported over $10 billion in revenue in 2023, a year-over-year growth of 33%, driven by both its online marketplace and digital payments platform, Mercado Pago. With nearly 40% of the e-commerce market share in key regions, Mercado Libre continues to expand its ecosystem, tapping into logistics and financial services. A stock split could make MELI more accessible as it capitalizes on rising internet penetration in Latin America. Then there's Booking Holdings, a leader in the global travel sector, with a market share of about 20% in online travel bookings. In 2023, Booking reported $17 billion in revenue, fueled by a rebound in travel demand. With a high PE ratio of around 35, Booking's growth is priced for premium returns. Driven by its network of over 2 million property listings across the globe, a split could lower the entry price, potentially attracting a new wave of retail investors. Both MELI and BKNG provide strong growth stories that can diversify a portfolio anchored by SCHD, adding exposure to two high-growth industries with substantial global reach. Chapter 5. Why these stock splits work well with SCHD strengths. So, how do these stock splits fit alongside SCHD? Well, SCHD is an excellent choice for steady dividends and stability. It provides a foundation with reliable income from solid dividend-paying companies. But to really balance your portfolio, it helps to add stocks that bring in different strengths, like the growth potential we see in LRCX, MCI, MELI, and BKNG. Lam Research and Supermicro Computer give you exposure to the booming tech sector, from semiconductors to data centers. Both of these areas are seeing rapid growth, which can help offset any slower periods in other parts of your portfolio. On the other hand, Mercado Libre and Booking Holdings are leaders in e-commerce and travel, two sectors with global appeal and long-term growth prospects. By combining SCHD with these stock splits, you're creating a diverse mix. SCHD provides that consistent dividend income, while LRCX, MCI, MELI, and BKNG add the chance for significant growth. Together, they can help you achieve a balanced portfolio that benefits from both income and market expansion. If you found this video helpful, please hit that like button and subscribe for more insights. And let me know in the comments, are you planning to add any of these stocks to your portfolio? I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next video.